In this lesson, we are going to deep dive into market imbalance. Now we're going to look at how the market moves and its nature, and we're then going to use this to help us get into trades as close as possible to where the largest players of the markets have their orders, and we're going to look at how to do this with pinpoint accuracy. Now, simply put, market imbalance, also known as fair value gap or price inefficiency, is when there is a difference between buy orders and sell orders. So when there is more buy orders than sell orders, for example, the market will move upwards, and vice versa if there is more sell orders than buy orders. And this is because for every order, there needs to be a counter order to fulfill it. So when there isn't enough counter orders on one level, the order buck will cause the price to move to the next level where there is enough counter orders for the market to balance itself. We can spot imbalance when looking at a chart, as it will show in the form of long candles and market gaps. Now, due to the sheer size of the markets that we trade, these large candles are usually the result of a block of orders being placed into the market by a large financial institution. When we spot imbalance on the chart, it implies that there are likely remaining orders resting at the source of the imbalance, waiting to be fulfilled. This knowledge is useful as the market will often naturally be drawn back to the source of imbalance, which is what allows us to enter into high probability zones with higher return on investment as we are moving with these large BFIs. When a market comes back to rebalance itself after being imbalanced, we call this efficiency. And this is the reason we focus on high volume liquids markets within our strategy, because they are more efficient in nature and they will come back to rebalance themselves completely, allowing us to get into better setups. Now, the markets I commonly trade and recommend are the euro dollar, the dollar yen, and the Dow Jones. These are the markets I have found are the most reliable and efficient. You can, if you want to, use other markets if you'd like, but make sure to backtest them, as you may find that the market won't pull back deep enough to trade the extreme supply and demand zones that we use as often. Now, traders, for us to achieve absolute consistency in our trades and enter in and out of these movements with pinpoint accuracy, we must set clear criteria instead of just looking for large candles on the chart. Imbalance will show specifically when the opposing ends of every other candle don't meet. In other words, in an uptrend, if the current candle's bottom wick doesn't meet the upper wick of the second to last candle, then it indicates imbalance. Now, I know that can be confusing to understand, and if this still doesn't make sense, you will find it easier to understand when we move on to the application side of the lesson. We will also in the future use an imbalance indicator that does this for us. So don't worry, you will pick this up.